Thanks, Tom. Thanks, everyone, for joining me on the fourth quarter fixed income funds review. Before I get started, I'll just give you a little bit of perspective on the quarter and the year. The way Tom presented equities and the numbers behind them, you're kind of left with the feeling that it was such a great year for equities, such a strong quarter for them as well, that this must have been conversely, a terrible year for bond funds. And if you expect that bond funds should always have positive returns because all they do is deliver interest income, then you might feel a little disappointed by what happened in 2013. On average, taxable bond funds did lose about 29 basis points. That wasn't as bad as a lot of the benchmarks that they use. So we saw active managers do pretty well in that regard. We saw the Barclays U.S. aggregate lose about 2% this year. That was its worst performance since 2007. We've also seen another year where the aggregate lost money, and that was in 1994 when the Fed was very aggressive about raising interest rates. The difference, of course, between now and 2007 and 1994 is that in 2007 we were the equity market was running away with things. I think people were expecting the housing the housing crash to settle in a little more nicely, and so we got a little distracted there. 1994 was all about Fed actions, raising interest rates very aggressively. So we kind of fit in between the two scenarios there. Overall, I didn't think, even though we lost money on average in the bond fund arena, I think that 2013 was not as bad as a lot of people imagined it could be. So let's take a look at the overall totals here for the fourth quarter. I'll make references here and there to the year, not necessarily for everyone, but just to give you a little perspective. So overall, when we're looking at the Treasury and government arena, it was not a good quarter. We saw widespread selling in Treasuries, no matter what flavor or tenor you're looking at. Corporates were definitely more in play. We saw decent returns out of the core plus area because they hold some high yield. You look down into the orange area here, the longer term general domestic and high yield ran away with performance figures for Q4. Loan pars did pretty well. You look farther down, mortgages kind of selling off, probably in sympathy with treasuries. World income was very different results, and we'll get into more of that later. And then munis actually perked up a bit in Q4. Well, let's start off by looking back at 2013 versus 2012. Here we have the average returns of all bond funds by their risk decile, meaning we're looking at standard deviation, looking at, I was using weekly figures here and annualizing them, putting them into deciles, and looking at the performance of those funds by each decile. So at the low end, over to the left in 2012, your lowest risk funds, the ones with the smallest volatility figures, they actually returned about 2%. This year, anything falling into the first decile for risk returned about 75 basis points. Not so bad. We look farther out here, we get up to like 9th and 10th decile for risk, and in 2012 you could pretty much throw anything out there. This was literally the spaghetti on the wall kind of investing. The higher risk, the better reward you got in general. This year, not so much. Those funds that took an extreme amount of risk generally lost money for doing so. There were some notable exceptions, of course. If you read our report on fixed income for the Q4, there were some funds out there with 28, 29% returns like Chew Income, Fair Home Focused Income. So there were some amazing results out there in Q4, but generally speaking, 2013 was not at all like 2012. You had to be very careful in your security selection in order to generate alpha for the quarter. So the next slide here is where we'll start looking at a couple of categories one by one. We noticed that the worst performers for this quarter were general U.S. Treasury funds, which is a long duration group, and inflation protected bond funds, generally composed of TIPS securities. Well, here's what TIPS did for 2013. When we look at some of the indicators for inflation, I think of commodities. So here the red line is the price of commodities over the year, and while it did bounce around between about plus or minus 5%, that's a pretty stable price time series for commodities. That's generally not going to be a great time for TIPS funds, because people would like to see TIPS funds having to prove themselves. So not only was inflation absent, and that certainly draws attention away from the TIPS market, but treasuries were also under pressure, so they fell in sympathy. So they weren't getting much of a lift from commodities, and certainly as we go into this, you'll see that treasuries had a tough time as well. So this is kind of the year-long perspective. Not much inflation out there. Inflation itself through TIPS funds really didn't materialize as far as performance goes. So this is what happened in the fourth quarter on the yield curve, looking at December versus Q3 and then Q4 of 2012. As you can see, the curve is heading higher over all 3 points. We increased we steepened the yield curve versus the quarter end of third quarter. Really from about 2 years out, 2-3 years is where we start to see a difference there. So it's the long end of the yield curve, the middle to the long end really, where we're seeing prices fall and yields increase. The short end, of course, still following very much the Fed funds range right now, 0 to 25 basis points. Not a whole lot of activity at that end of the yield curve. And then over the quarter, each of the what I would consider benchmark tenors. We noticed the 5-year especially jumped up in yield over the quarter. 30-year, not so much considering where it began. So we're really seeing a lot of repricing pressure at the belly of the curve. Next group to take a look at is corporate bond funds, high yield, the corporate debt BBB, as well as A-rated funds. All were in the black for the quarter. All had a pretty decent year, especially high yield funds. They ended 2013 up 6.82%. They had over a 3% return for the quarter, as you can see. So overall, it was a pretty good time to be in high yield. The A-rated ended up losing money for the year, down about 1.7%, and BBB was slightly better, down about 1.2%. So high yield has definitely been a great place to be. They're perking up in line with equities, which is not unusual. That's their historic trend. And for that, we also note that default rates for high yield securities is still very low. It's about 2.4% right now. A year ago it was about 3.1%. So things are looking up for high yield. Over the course of the quarter, high yield was utterly unstoppable. If we index all of these to starting at 0, starting the clock at 0, if the more credit risk was inherent to your security, the better off you likely did. A-rated or AAAs in this case just kind of meandered about, didn't really pick up a whole lot of interest by investors who really thought that interest rates risk was a major consideration, credit risk not so much. So as a consequence, our A-rated group was one of the poorer performers among the corporate debt areas. So this gives you a flavor for how strong credit markets were in terms of putting money to work in lower credits and really looking at that default rate as an indicator of risk and really shying away from interest rate risk instead. And here's a little curious point I want to make as well. This is the issuance of corporate bonds over the last 10 years. 2013, we actually saw a slight decline on the investment grade side. This kind of backs up the previous slide where we saw, especially in the fourth quarter, your AAA rated debt really not go anywhere as far as price, while high yield in terms of issuance year over year was slightly better. I would say that the demand for high yield is greatly outstripping supply. That's why when we look at this slide, slight increase in issuance, but a major outperformance in terms of returns, and so therefore I we'll follow this up at the end. High yield is really in play right now, and is going to be a strong contender at the beginning of this year as well. I mean, as far as I can look out. So overall, investors seem to be shying away from the high grade just because of interest rate risk. Next group I want to take a look at is in the world income area. As you can see, this kind of is a counterpoint to what Tom was talking about, where everything that was associated with the U.S. tended to do better on the equity side. This time, international income was a very strong performer, especially as European credits perked up, even though Europe is slated to post a very weak GDP growth in 2014, looking somewhere around 1% on the top side. What's interesting about the fourth quarter is the divergence of emerging market hard currency and local currency. So for those unfamiliar, the hard currency is where an emerging market sovereign nation would float bonds out denominated in dollars or euro, something that's widely accepted around the world. Local currency would be just that, a Brazilian real or Mexican peso. These groups performed very differently in Q4. So, for example, the local currency debt funds lost about 1.3%. I'm afraid my scale on the bottom here is off. These funds lost about 1.3%, while the hard currency gained about 80 basis points. So disregard the scale at the bottom there. So here's what we're talking about in terms of the difference of hard currency and local currency over the year and where they diverged in the fourth quarter. Fourth quarter is when we got talking about tapering, the impact that would have on emerging markets. I think investors felt that, or at least the market felt, that denominations in hard currencies were a safer play. They moved money that direction, while the local currency was just more risk. As we take that as we take that stimulus away, some of that appetite for risk goes with it. So we saw investors move toward the hard currency flavor throughout the fourth quarter. Generally, they trended together throughout much of the year, especially over the summer. No one really noticed a difference there, but certainly in the fourth quarter, where we saw local currency at least using two benchmarks here. Well, one's sort of a benchmark, the JP Morgan EMBI Plus. That is your hard currency benchmark. I use the market vectors, emerging markets, local currency, because we didn't have the JP Morgan GBI index available, but this one tracks very closely to that one, so a pretty good proxy for the local currency market. It's definitely on a slide right now, and I expect that to continue into the new year. The last group we'll take a look at here is municipal debt funds. Things have not gone well for munis at all this year. Billions and billions of dollars of outflows from retail investors, and they are a big portion of the muni market. So outflows definitely impact the price of securities for munis, which is kind of a tough place for munis to be. It's kind of a death spiral that's hard to get out of, simply because more outflows beget lower prices, which beget more outflows, and putting an end to that spiral is going to take some time. I don't see that ending in the early part of this year. We'll have to see how flows go in the next couple of weeks, but I think we're going to get more of the same. There's a couple of reasons for this. So here we take a look at treasuries and the general obligation muni index from Bond Buyer. The premium, the risk premium for munis remains steady. I mean, they pretty well tracked the 10-year market and kept a pretty wide spread over treasuries, as no one really wanted to let go of jump into the muni market. We've seen lighter and lighter supplies as interest rates increase. Cities are less likely to refinance. And no one really wants to buy muni paper these days anyhow, so it's a tough place for the muni market overall. Spreads aren't going anywhere. The interesting thing here is that munis are still yielding more than treasuries on a pre-tax basis. So after tax, I think it's quite a good deal to be in munis, especially if you're either dollar cost averaging or you haven't been in munis and you want to try it now. It's a pretty good market right now, especially for that tax exempt return. Next slide gives you some indication of what's going on with high yield munis and why people are getting out of munis overall. Puerto Rico is a U.S. territory that is able to issue bonds that are triple tax exempt, so they're treated within a municipal debt portfolio as if it was invested in its own state or anywhere that particular strategy invests. So they get all the benefits of being a muni debt play, but Puerto Rico has quite a crisis on its hands with regards to its budget, and the market does not like what it sees in Puerto Rico debt right now. It's on the very last rung of investment grade using the S&P rating here of BBB minus, so it's at risk of falling below investment grade, and that could lead to massive sell-offs as a lot of portfolios are required to hold investment grade muni debt. So things are not looking good. The market is telling us that these are really high yield securities. There are some issues with this particular chart. One of them being that the general obligation market in Puerto Rico is relatively small compared to where a lot of fund managers are putting their money to work these days. So it's not exactly the case that all Puerto Rico debt should be treated the same. But generally speaking, if we're going to come up with a benchmark here, this is a fair comparison in that sense. So definitely under pressure, and they're widely held. There are some funds that are faring much worse because they're holding a lot more Puerto Rico debt than others. That's probably why they outperformed their peers over the last couple of years. So I have a couple of concerns looking ahead, sort of an outlook piece here. I'm concerned with the debt ceiling potential battle that's on the horizon in Washington. February 7th is the deadline to meet the debt ceiling. Of course, as we all know, they play with these numbers, and it could be anywhere from March to May is the actual debt ceiling moment where the government's supposed to run out of money. We'll see how receptive the two sides are to playing nicely with each other. It didn't go well the last time around, so I'm expecting more of the same. This might be, depending upon how it works out, this might be good for bonds. If it's resolved quickly, it's probably bad. The other concerns I have, the economy is steady. It's not spectacular. That could be a positive for bonds, but without better economic activity, we could see some lighter interest in high yield, which is really kind of the only good place. Well, loans are pretty good as well. I think that when it comes to Janet Yellen, we're going to have continued ultra easy money. I don't think the 0 to 25 basis point policy is going anywhere until we get to 6.5% unemployment and inflation, long-term inflation prospects less than 2.5%, which seems pretty doable. Finally, I think loans and high yield remain attractive. Treasuries and emerging market really are in a tough spot right now, and I don't think that's going to ease. So